Alphabet, which is of course the parent company of Google, is a hot topic right now because of the change that we are seeing with AI and search engines. It is the first time that Microsoft is really bringing the fight to Google. It is also the first time that the possibility of Google losing its dominant position in the market doesn't seem that crazy anymore. And such moments in history create an opportunity for us as investors. So let's analyze Alphabet, let's value it, and also let's look at its recent financial results to see how much of this shift is backed by numbers and facts and how much of it is just media noise. Revenue is up by 3% year over year. Net income went down by 8.4%. And the main reason for that are rising costs for research and development and sales and marketing. Long-term debt decreased by 6.8%. And at the same time, cash and cash equivalents went up by 18.5%. These results are not great. They are not exceptional, but they are good. If we consider the fact that it is a tough time for Alphabet, then they are dealing with it quite nicely. So now let's see who owns this company. Individual insiders, that is a check at 13.3% of the company owned by individual insiders. And we like to see this number over 2%. So if individual insiders own so much stock, it means that the shareholders are in good hands. The management will take care of them because it's in their own interest. And the main owners of those shares are Lawrence Page and Sergey Brin, the founders of Google. And are individual insiders buying right now? That is an X. We see only sale transactions in the last year. And super investors, do they own shares of this company? That is a check. 31 super investors own shares of Alphabet. And that makes it the most popular company among super investors. And are super investors buying right now? That is an X. When we look at the last quarter of 2022 and the data we already have from the first quarter of 2023, we see that they bought 5.6 million shares and sold 8.8 million. Return on invested capital. That is a check at 16.1%. 10-year median returns. And we want to see this number higher than 10%, so that is a solid result. And free cash flow growth? That is also a check at 16.2% 10-year compound annual growth rate. It is also over 10%, just as we like it. And now let's take a look at the net profit margin. It is a check at 21.2%. And the industry average is 20.9%, so they are just above average. And when we look at the main competitors, we see that Meta has a net profit margin of 19.9%. So Alphabet has a slight advantage over them. But then, when we look at Microsoft, it is at 33%. And Tencent has a net profit margin of 33.9%. So Alphabet doesn't really have an advantage over the industry, and it is actually lagging behind some of its competitors. And now let's take a look at share buyback. It is a check with 5.4% of shares bought back in the last 10 years. And what is really important is that the board of directors of Alphabet authorized a massive share buyback program worth $70 billion. So they believe that the shares are cheap right now, and it's a good idea to buy back a lot of shares to benefit the shareholders in the long run. And what do we know about the debt of the company? it is a check. It would take them just few months to pay the long-term debt with a current free cash flow. So they have no problem with that. And if we take into consideration the amount of cash they have, then we see that Alphabet can pay its debt at any moment without any problems. To value Alphabet, we will have to estimate its growth for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So in the lowest scenario, we will estimate a growth of 10% for the first 5 years and then 8%. In the medium scenario, 12% and then 10%. And in the high scenario, 17% and 13% from year 6. And even though these estimates may seem high, if we look at the last 10 years, we see that the revenue grew on average by 19.9% every year. Free cash flow grew by 16.2%, and earnings per share grew by 18.9% annually. So I really believe that these estimates are actually quite conservative. Even the high scenario is significantly lower than the last 10 years of growth for Alphabet. And that is exactly what we want when we estimate a growth of a company. We want to be conservative because that creates a margin of safety. So with such estimates, we get $104 in the low scenario, $120 in the medium, and $161 in the high scenario. But of course, these are not the actual prices we should be looking for, because we always have to add a margin of safety. I use a 30% one, and such a margin gives me a lot of room for error. My estimates, even though they are conservative, may turn out to be wrong, may turn out to be too high. And in such a situation, the margin of safety can be crucial in saving my money. So with the margin of safety, we get $72 in the low scenario, $84 in the medium, and $113 in the high scenario. And the current share price is $104. So we have the medium and high scenarios in the green, as well as the high scenario with the margin of safety in the green. The low scenario is almost exactly the same as the current share price, and the low and medium scenarios with the margin of safety are in the red. Now, it seems like there is a really big chance that Alphabet right now is fairly priced. And Warren Buffett reminds us frequently that buying a great company at a fair price can be an exceptional investment. So it seems that Alphabet right now is still a strong and growing company, but the recent results show also that it is not as strong as some of its competitors. And that may be one of the reasons for the price decline. Now, if you believe that it is just a temporary problem and that they will come out on top, then the current price may be a great investment possibility. On the other hand, if you believe that these results are just a beginning of a decline for Google, that this company has its best years behind, then you should avoid this investment. So let me know what you think in the comments, and see you in the next one. Bye bye.